Hi, my name is Phil Greenwood, and welcome to the first in a series of podcasts for the Wisconsin Entrepreneurial Bootcamp related to financial statement analysis. I am a senior lecturer at the School of Business, the Wisconsin School of Business in Entrepreneurship, Finance, and Strategy, and have also been a teacher and a lecturer in the bootcamp for the past several years. This series of podcasts will focus mainly on the major financial statements of a company, the income statement and the balance sheet, but also provide some ways to analyze the statements to kind of monitor how well a company is performing. Throughout this section, what we're going to do is cover the balance sheet, the income statement, and the statement of cash flows. This section particularly a focus on the balance sheet. Think of the balance sheet as the snapshot of the company's financial condition as of a point in time. Think of the income statement and the statement of cash flows as the video recording of the revenues, the expenditures, and the profits in between the two balance sheet dates. In this case, July 1 to June 30th. So all three statements are interrelated, and we'll show that hopefully throughout this series of podcasts. At the end of this, we hope we provide some insight as to the understanding of the financial performance of any type of company. Today we're going to focus on this section on the balance sheet. The balance sheet tells you the specific financial position of the company as of a particular day. What it does is it's going to show you what the assets of the company, in other words, the resources it owns, that they expect to get benefit from in the future. The liabilities, in other words, the obligations it owes to outside parties that they'll have to pay off either within the next year or longer, the sacrifices that we'll have to make in order to receive the benefit of the assets, and then finally what's left over for the shareholders or the owners in the form of shareholders' equity. At the bottom you can see what we call the accountant's equation that has to hold for any balance sheet. In other words, total assets, the value of what we own, has to equal what we owe to our suppliers, our employees, and the obligations to other parties, plus what's left over for the shareholders, or what we also may call the owner's equity. Critical that if this equation does not hold, it means our books are not in balance and that there are some issues with the reports. For this section, and also in later sections, we're going to use the financial statements of a company called Symantec, which is a company that's been around for a number of years, selling antivirus protection software. In this section, we'll look at their balance sheet from 1990 and 91. We'll look at the composition and current assets, long-term assets, versus its liabilities, both current and long-term, and then also what's left over for the shareholders for both of the years. This is the balance sheet for Symantec for 1991 and 1990. These are numbers that we've used in a previous case study for McAfee and Symantec, and provides kind of a foundation for the future podcasts. 1991 are the numbers on the left, to your left as you're facing it. You can see cash of $24.872 million. And on the right is 1990. So we're saying as of the end of the year for each of those years, here's the financial position of Symantec. You can see it has a great deal of cash on hand, the same amount for both years, but you can also see it has a pretty significant amount in 1991 of accounts receivable. In other words, what do customers owe us at the end of the year? More than double from the previous year. Has a little bit of inventory on the shelves to be sold, and it has some property, plant, and equipment, which can include the computers, the buildings that people work in, anything the company owns that's a long-term asset. And then something called other assets, which might be the value of any licenses, patents, or a variety of other things. Below you can see the liabilities and shareholder equity section. In other words, the financial capital used to finance the assets. You'll see the accounts payable, which are what we owe to our outside vendors outside the company. Also accrued expenditures, which can include the salaries owed to employees but not yet paid at the end of the year, taxes that are owed to the government, or a variety of miscellaneous expenditures, and also a category called current portion of long-term debt. In other words, what we have to pay off in our principal to our bank loan that has to be paid off within the next 12 months. That comprises total current liabilities, the obligations that we have to pay off in the next 12 months. Below that, you'll see long-term debt, which is a very small amount in 1991. That's the bank loans that Symantec owes to a bank and has to pay off beyond the 12-month period. And then you'll see at the end the shareholders' equity section. In other words, the assets minus the total liabilities, what's left over for the shareholders, which is comprised of any common stock that was sold and also profits that have been kept in the business from operations from the beginning of when the business started. Key thing to note, the current assets and current liabilities, again, those are things that are only going to be on the books for less than a year. Typically, companies try to match those up as best they can. So our current liabilities are at least, our current assets are at least greater than or equal to our current liabilities. And then the long-term liabilities and shareholders' equity, we tend to use that to finance what's left over from our current assets that can't be financed by current liabilities, but also to help finance our longer-term assets. So we'll be utilizing this balance sheet throughout when we talk about analyzing the financial statement and specifically looking at, in combination with the income statement, the performance of the company.